Hey everyone, welcome back to Corporate Decoder. Today, PPG Industries Incorporated just filed its annual report on Form 11K, and I am seeing how their employee savings plan is performing as the market fluctuates. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a really clear look at how a big company's retirement savings are invested, and it shows a pretty interesting mix of investments. So this is an annual report for the PPG Industries Employee Savings Plan. Think of it like a yearly checkup on the money saved by employees in their retirement accounts. It covers the year that ended on the 31st of December 2025. Let's dive straight into the numbers. This table shows us the total value of all the money in the plan. As of the 31st of December 2025, the total investments were worth over $4.1 billion. That is a big chunk of change compared to the previous year, the 31st of December 2024. The total investments were a bit higher at $4.2 billion. So, we actually saw a small dip in the total value of these employee savings over the course of 2025. Now, let's look at how that money changed throughout 2025. The plan added about $698 million to its accounts. That came from a few places. They had about $520 million in investment income, meaning the investments made more money. Plus, employees and the company together contributed another $178 million. That sounds good, right? But then the plan paid out $822 million to employees who were withdrawing money. This means that more money went out of the plan than came in during 2025. This resulted in a net decrease of $127 million in the plan's total assets. So, while investments grew, the withdrawals were higher, leading to a smaller overall pot at the end of the year. Now, for the really interesting part, what exactly is this money invested in? We can see a breakdown of these investments. For instance, on the 31st of December 2025, the plan had $334 million invested in PPG Industries, Incorporated owned stock. This is the company's own stock, which is interesting because it means employees are essentially investing in their employer's performance. They also had $129 million in other mutual funds and $7 million in money market funds as of the end of 2025. A significant portion, over $3.2 billion in 2025, is invested in something called common collective trusts. These are basically pools of money from different retirement plans that are invested together. It is a way to get access to a wider range of investments, often including things like index funds or specialized bond funds. These are valued at about $3.2 billion as of the 31st of December 2025. Looking at the specific holdings, we see a lot of different types of investments. There are mutual funds like the Baillie Gifford Emerging Markets Fund and the JP Morgan Equity Income Fund. Then there is the company's own stock, PPG Industries, Incorporated Common Stock. The report lists many common collective trusts, which are essentially large investment funds managed by firms like BlackRock, Ben Mellon, and Fidelity. These funds invest in a broad range of assets, providing diversification for the plan participants. The plan also holds a variety of US Treasury notes with different interest rates and maturity dates. For example, there are notes with interest rates like 3.50% maturing in 2028 and others with 4.125% maturing in 2028. These types of investments are generally considered very safe. In total, these US government obligations were valued at $234 million at the end of 2025. Then we see a really large category of corporate debt. This means the plan is lending money to many different companies. We see bonds from giants like Alphabet, Incorporated, American Express Company, Bank of America Corporation, and many, many others. These corporate bonds are essentially loans that the plan has made to these companies, and they come with different interest rates and maturity dates. The total value of these corporate debt holdings was $109 million at the end of 2025. There is also a significant investment in mortgage-backed securities, totaling $17 million. These are basically bundles of mortgages that have been packaged and sold as investments. We see a variety of these, including those backed by Fannie Mae and Freddie Mac, with different interest rates and maturity dates, some stretching out to 2040 or even 2047. And then there are asset-backed securities, which amounted to $36 million at the end of 2025. These are similar to mortgage-backed securities, but they are backed by other types of assets like auto loans or credit card receivables. For example, we see asset-backed securities from car companies like BMW, Ford, and Volkswagen, as well as from credit card issuers like American Express, Chase, and Citibank. This shows a diversified approach across many different kinds of debt instruments. Finally, there are cash and cash equivalents like the Fidelity Investments Money Market Government Portfolio, valued at $7 million. These are typically very safe, short-term investments. The plan also includes a stable value fund, which is designed to preserve principal and earn stable income. This fund invests in a mix of fixed income securities and is valued at $403 million. This type of fund is often used in retirement plans to offer stability. Interestingly, the plan also holds $46 million in loans to its participants. This means employees have borrowed money from their own retirement accounts. The interest rates on these loans range from 3.25% to a pretty high 10.50%, and some of these loans mature as late as November 2055. Now, looking at these results a bit more broadly, the PPG Industries Employee Savings Plan showcases a really diversified investment strategy. It includes the company's own stock, which aligns employee interests with the company's performance. There is a significant allocation to common collective trusts and various fixed income securities like US Treasuries, corporate debt, and mortgage and asset-backed securities which add stability. The net decrease in assets available for benefits in 2025, primarily driven by withdrawals exceeding contributions and investment income, might be a point of concern, suggesting employees are cashing out more than usual. This could be due to various factors like market conditions, personal financial needs, or perhaps a lack of confidence in future growth. The high interest rates on some participant loans are also noteworthy, essentially acting as a high-yield investment for the plan itself, though it is critical for participants to manage these loans responsibly. The risk I am watching is how the plan's overall net assets fluctuate based on market performance versus participant withdrawals, and whether this trend continues in future years. What I am actually looking for is a sustained period where contributions and investment gains consistently outpace withdrawals to ensure the long-term growth of employee savings. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.